When countries like China and Japan hold a significant amount of U.S. debt, it essentially means they own U.S. Treasury securities, financial instruments issued by the U.S. government when it needs to borrow money. These securities function as IOUs, guaranteeing repayment of the borrowed funds along with interest. Purchasing these securities allows other countries to lend money to the U.S. government. But why would nations be interested in doing this? U.S. debt is widely regarded as one of the safest investments globally due to several factors. The United States has a long-standing reputation for honoring its debt obligations. Additionally, the U.S. dollar serves as the most commonly used currency in international trade, enhancing the appeal of U.S. Treasury securities. For countries seeking a low-risk avenue to invest their funds, U.S. debt provides a reliable option. Countries that export extensively to the United States often accumulate significant amounts of U.S. dollars. Instead of merely holding this cash, they frequently invest it in U.S. Treasury securities. This strategy not only provides a return on their holdings but also stabilizes their domestic currency and keeps their exports competitively priced. By investing in U.S. debt, these nations effectively manage their foreign currency reserves, which function as a type of emergency savings. Rather than allowing these reserves to remain idle, purchasing U.S. Treasuries ensures the funds are both secure and productive. Moreover, buying U.S. debt fosters stronger economic and political relationships. Investments in each other's economies create mutual benefits and bolster international partnerships. Maintaining a financial stake in the U.S. economy aligns interests and promotes stability in diplomatic relations. The U.S. Department of the Treasury releases data monthly about how much U.S. debt is held by foreign entities. This information is published in the Treasury International Capital (TIC) report, which details the buying and selling of U.S. Treasury securities by foreign countries. The data, released around the middle of each month, reflects holdings from 2 months earlier. For example, a report issued in March would reveal data from January. Recently, the TIC data highlighted a significant global sell-off of U.S. Treasury securities between November 2024 and January 2025. This period marked one of the largest and most coordinated reductions in U.S. debt holdings by foreign governments in recent history, with a total estimated sell-off exceeding $390 billion. This widespread shift involved countries across various regions, including North America, Europe, Asia, and the Middle East. Among the largest sellers was Brazil, which reduced its holdings by approximately $55.9 billion. Ireland, a prominent financial hub, followed closely by cutting $42 billion. The Cayman Islands, known for its offshore financial services, sold $41.2 billion. Canada also made a substantial reduction, offloading $37 billion worth of U.S. Treasury securities, a move that raised questions given its historically strong economic ties with the United States. Other notable reductions included Norway, $35.6 billion, India, $34.9 billion, the United Kingdom, $26.6 billion, Singapore, $26.5 billion, and South Korea, $22 billion. Even Japan and China, the two largest foreign holders of U.S. debt, participated in the sell-off, with each reducing their holdings by $7.8 billion. Though these reductions were smaller in comparison, their symbolic significance suggests a cautious reevaluation of U.S. debt by even its most consistent creditors. Several factors contributed to this coordinated sell-off. One major reason was the high interest rate environment in the United States. Rising interest rates diminish the appeal of older Treasury securities with lower yields, prompting investors to sell. Additionally, the strong U.S. dollar and volatility in global currency markets have pushed central banks to diversify their reserves and reduce reliance on dollar-denominated assets. Geopolitical risks also played a crucial role. Escalating tensions following the Russia-Ukraine war, combined with deteriorating U.S.-China relations, have made many nations wary of overdependence on U.S. assets. Concerns about potential sanctions, asset freezes, and the broader weaponization of finance have driven central banks to explore alternatives such as gold, euros, or other reserve currencies in a process often referred to as de-dollarization. Another contributing factor is growing apprehension about the fiscal health of the United States. With persistent budget deficits and a rising national debt, some investors are questioning the sustainability of U.S. borrowing. The timing of this sell-off, coinciding with the return of Donald Trump to the presidency in January 2025, has further heightened concerns. Trump's re-election has revived global unease about U.S. fiscal policies and geopolitical strategies. His America First agenda, marked by protectionism and unilateral economic actions, has prompted many foreign governments to hedge against potential risks. During his first term, Trump's administration imposed tariffs, withdrew from international agreements, and used financial tools like sanctions to exert influence. With his return to power, foreign investors are bracing for renewed uncertainty and taking preemptive steps to protect their economies. Within weeks of resuming office, Trump reinstated tariff threats, reevaluated trade agreements, and signaled a tougher stance on foreign investment in critical sectors. These developments have fueled fears of trade tensions and economic instability. The synchronized reduction in U.S. Treasury holdings by a diverse range of countries reflects this growing apprehension. The United States is also set to implement significant reciprocal tariffs starting April 2, 2025. This policy, part of Trump's agenda, seeks to align tariff rates imposed by trading partners on U.S. exports. While designed to reduce trade imbalances and protect domestic industries, these tariffs are expected to have widespread economic effects. Domestically, the tariffs could raise consumer prices, particularly for products reliant on imported materials. This inflationary pressure is expected to slow progress in reducing inflation, according to Federal Reserve Chair Jerome Powell. Internationally, the tariffs could disrupt supply chains, realign trade relationships, and strain diplomatic ties. In response, key trading partners, including the European Union, China, and Canada, have announced or are considering retaliatory measures. These actions could lead to a broader trade conflict, with long-term implications for global economic cooperation. As nations adjust their strategies and reduce reliance on U.S. debt, the global financial landscape continues to evolve, reflecting shifts in trust, geopolitical priorities, and economic policies.